Sukhija Accounts Teachings by Ramesh Kumar. My mobile number is 61435205206 and my mail ID is kumar.ramesh5759@yahoo.com. Now today we are going to take a question on retirement where normally it is given assets and liabilities are to be shown at old values or on new values. In this question, we are taking both the cases where assets and liabilities, when the change in the value is to be recorded in the books, that is, assets and liabilities are to be shown at new value. When the assets and liabilities are to continue appear at their old figures, that is, there will not be any change in the assets and liabilities. So here there are three partners C, D, E. They are sharing profit in the ratio of 3:2:1. D retires and the share of goodwill in the firm is valued at rupees 60,000. Here you are given the value of goodwill of D share 60,000. Assuming that C and E agree to share future profits in the ratio of 3:2. New ratio is given to you 3:2 respectively. Pass an adjustment entry to credit retiring partner with the share of goodwill. Show calculations clearly. Because 60,000 will be transferred to D, it will be taken from C and E. In which ratio? In gaining ratio. How will calculate gaining ratio? New share minus old share. New share of C and E is 3:2 and old share is 3:2:1. So gaining ratio we will calculate C's gain 3/5 minus 3/6 and E's gain 2/5 minus 1/6. And whatever the gaining ratio will come, we will transfer the goodwill from C and E to D's capital. We will write C's capital account debit, E's capital account debit to D's capital. The balance sheet of the firm as on 31st March 2012 was as follows. D retired on that date. That on this date, on 31st March 2012, D has retired. Now here you are given Sunday creditors in 1000. That is 1,90,000. Bills payable 50, that is 50,000. Reserve 120, that is 1,20,000. Capital account C 4 lakh, D 3 lakh and E 2,50,000. Total of capital is 9,50,000. Now on asset side, cash at bank 25, that is 25,000. Debtors 160, that is 1,60,000. Less provision for bad debts 5 means 5,000. In amount column 1,55,000. Stock 2,50,000. Furniture 80,000. Plant and machinery 3,50,000. Factory building 4,50,000. The total is of balance sheet is 13,10,000. Again, he is giving goodwill of the firm is valued at rupees 1,80,000 and D be given credit for a share of goodwill. So D share is coming 2 by 6. 2 by 6 means 1 by 3. That is 1,80,000 into 1 by 3, 60,000, which he has already given. Plant to be depreciated by 10% and furniture by 15%. Plant to be depreciated by 10%. If you see carefully, plant and machinery is 3,50,000. So we have to depreciate it by 10%. So 10% of 3,50,000 comes 35,000. And furniture by 15%. Furniture is 80,000. 15% of that comes 12,000. So furniture has depreciated with 12,000. Stock to be appreciated by 20%. Value of stock has increased by 20%. Stock is 2,50,000. So 20% of that comes 50,000. And building by 10%. The value of building is 4,50,000. 10% comes 45,000. Provisions for bad debts be increased by rupees 20,000. Already provision was 5,000. Now he has increased by 20,000. So new provision would be 25,000. So but debtors are decreased with 20,000. Liability for workman compensation to the extent of 16,000 to be brought into account. The liability for workman compensation is 16,000. This is to be shown in the books. Past journal entries, prepare revaluation account, capital accounts and balance sheet. Case 1. When the changes in the value to be recorded in the books. You are to show the changes in the value of assets and liability in the books. And second, when the assets and liabilities are to continue to appear at their old figures, that in the new balance sheet, you are not to show the changes. Assets and liabilities are to appear at old value. So first of all, we are giving entries for general reserve. General reserve here it is given 1,20,000 on liability side. So general reserve is always distributed in old ratio. We are taking first case when changes are to be shown in the books of accounts. So reserve account debit to C's capital, to D's capital, to E's capital. Reserve account debit 1,20,000, to C 60,000, to D 40,000, to E 20,000. Narration would be transfer of journal reserve to old partners in their old profit sharing ratio. Then we are to come for goodwill. For goodwill, what we are to pass? C's capital account debit, E's capital account debit to D's capital. To D's capital is 60,000 because it is given. Now 60,000 we will take from C and E in gaining ratio. Old ratio is 3:2:1. New ratio is 7:5. So first C is gain. 7 by 12 minus 3 by 6. 7 by 12 minus 3 by 6, how much it comes? 1 by 12. Then, old ratio is 3:2. And then other is coming 7 by 6, 7 by 12 minus 3 by 6, and then 7 by 12, 5 by 12 minus 1 by 6. The gaining ratio comes 3:7. So 60,000 when we divide into 3:7, C's capital account debit 18,000, D's capital account debit 42,000 to D's capital 60,000. The ratio would be transfer of goodwill to D's capital charging C and E in their gaining ratio, that is 3:7. Then we are coming to revaluation entries. Revaluation account debit to plant and machinery. Plant and machinery has decreased with 35,000. To furniture, furniture has decreased with 12,000. Then that is factory building, land and building with 20,000, and provision for workman compensation 16,000. Liability has increased. The total comes to 83,000. Again listen it, revaluation account debit 83,000, to plant and machinery 35,000, to furniture 12,000, to land and building 20,000, then to provision against workman compensation 16,000. Totals comes to 83,000. Now stock has increased, building has increased. Stock account debit 50,000, building account debit 45,000, to revaluation 95,000. If you prepare revaluation account, on the credit side coming it is 95,000, on the debit side it is coming 83,000, so there is a profit of 12,000. This will be transferred to all the partners in their own profit sharing ratio. Revaluation account debit 12,000, to C's capital, to D's capital, to E's capital. To C's capital 6,000, that is 3 by 6. To D's capital 2 by 6, 1 by 3, 4,000, and to E's capital 1 by 6, that is 2,000. Then we have to prepare partners capital account. In partners capital account, by balance BD, C 4 lakh, D 3 lakh, E 2 lakh 50,000. By reserve, C 60,000, D 40,000, E 20,000. Now in D's capital, by C's capital 18,000, by E's capital 42,000, that is for goodwill. Then by revaluation profit, C 6,000, D 4,000, E 2,000. The total of D is coming 4 lakh 4,000. So since he is not saying anything regarding payment, so we will transfer this amount to his loan account, to D's loan account under D 4 lakh 4,000. Then on the debit side, to D's capital, under C 18,000, under E 42,000. Then to balance CD, under C 4 lakh 48,000, under E 2 lakh 30,000. The balance will be shown there. To balance CD, C is coming 4 lakh 48,000, D is coming 2 lakh 30,000. Then we have to prepare the new balance sheet. Under new balance sheet, creditors 1 lakh 90,000, there is no change. Then next is bills payable. These payable are 50,000. There is no change. Then what we are having, that is capital accounts. Oh sorry, these loan account 4,04,000. We are having workman compensation fund. Workman compensation 16,000. There was increase in liability. Then capital accounts C 4,48,000, E 2,30,000. The total of balance sheet is coming 13,30,000. Now on asset side, bank 25,000, debtors 1,60,000 minus 25,000, 1,35,000. Then stock is stock is 30,000. Then we are having furniture 68,000, plant and machinery 3,15,000, and land and building 4,45,000. The total is coming same 13,30,000. So one entry more in general we will pass, that is these capital account debit to these loan account with how much 4,04,000. This is the case when we are to show assets and liabilities at the change value. When assets and liabilities are not to be shown at change value, in that case, instead of revaluation, we will make memorandum revaluation account. Memorandum revaluation account would be in the same pattern, but rather it would be extension of revaluation account. First on the debit side, you will show in the same way two plant and machinery 35,000, two furniture 12,000, two land and building 20,000, two provision for workman compensation 16,000. On the credit side, buy stock 50,000, buy building 45,000. Then you will show the profit in the same way. To profit transfer to C 6,000, D 4,000, E 2,000. That is in the normal way as we prepare. But we will write profit and revelation, memorandum revelation account. Then whatever we are showing on the debit, we will show on the credit. On the credit side, it will come 83,000. On the debit side, it will come 95,000. We will write all the items. Then we will show loss of 12,000. C 7,200, E 4,800. And so we will have one more entry here, that is C's capital account debit, D's capital account debit, to memorandum revaluation account, that is 12,000, 7,200, 4,800. Also we have the reverse entries for decrease in assets and decrease in liabilities. That is, first we were showing revaluation to assets or liabilities. So how we will show the reverse entry there? That is, we will show plant account debit, furniture account debit, land and building account debit, provisions for workman compensation account debit to revaluation 83,000. Then revaluation account debit to building 45,000. 5,000, to stock 50,000, that is 95,000. Then by loss, transfer to C, D, E in their ratios. That is C's capital account debit, D's capital account debit, E's capital account debit to revaluation 6,000, 4,000, 2,000. We will reverse the entry. Then we will come to the capital accounts. Buy balance BD, that is 4 lakh, 3 lakh, 2 lakh, 50,000. Then in the same way, buy C's capital under D 12,000, buy E's capital under D 28,000. Then that is we have buy E's capital 42,000. To D's capital under C 12,000, under E 18,000. To D's capital under C 18,000, under E 42,000. To memorandum revaluation 7,200, 4,800. To D's loan account 4 lakh 4,000, and the balance CD would be the capital. In the capital, in the new balance sheet, we will show the same creditors 1,90,000, bills payable 50,000, reserve 120, 1,20,000, and capital accounts whatever we are getting. Then cash at bank same, debtors 1,60,000, less provision 5,000, 1,55,000, stock 2,50,000, furniture 80,000, plant and machinery 3,50,000, factory building 4,50,000. So both sides of balance sheet will come 13,10,000. So here you have to take care of that. When assets and liabilities are to be shown at the old values, the entry for reserve would also be in the same way as we have done for goodwill. So therefore we will pass entry for reserves in the same manner. We will give reserve to D and we will take from C and E. Reserve here it is given 1,20,000. Old ratio was 3:2:1. So D will be given 2/6, 1/3, that is 40,000. 40,000 will be charged from C and E in their new ratio 3:2. So that is 12,000 and 18,000, 28,000. In this way we will pass the journal entries. If you like this video, kindly like, share and subscribe it. Thank you very much.